Welcome to Witham Sounding Board, a podcast sharing powerful business tips, insights, and trends for those seeking to become a rock star in their industry.
Hi, welcome. I'm Steve Monticelli, and welcome to our What the Hemp podcast series here at Witham. And we are launching this series to talk about what's facing the industry today. We just want to do a fireside chat relative to some of the hot topics of what people are talking about in the optimization of financial reporting and tax return preparation for the cannabis space. With us today, we have Wendy Heiss, who is a partner in the assurance services side of the house at Witham, and Ray Owens, who's a senior tax manager specializing in the cannabis space as well. Tell us a little bit about, we're going to talk today about the non-280E position that we hear splashed across the press. A lot of CEOs and consultants and attorneys are talking about the non-280E position that cannabis companies are currently taking. We want to explore what it means, what it is, what it looks like from a tax return perspective, what it looks like from a financial statement return perspective. The two are not necessarily in congruence with each other, and that's the purpose of this podcast. So, Ray, why don't you kick it off? Tell us a little bit about, what's the underlying nature of the non-280E position?
Sure, Steve. Thanks, and happy to be here. So just to kind of set the stage a little bit, right? So cannabis has been around forever, and in the 80s, there was 280E was created. Right. There was a court case where the IRS tried to tell a taxpayer that he had to pay tax on his gross receipts for selling drugs, and they thought it was a slam dunk. And unfortunately, they got embarrassed in court, where the court said there's no tax law that says it's not a business. So he can run it like a business, calculate his taxable income. And the guy wound up paying like $200 worth of tax. And it was very embarrassing. So Congress turned around, created 280E, and said that if you are selling illicit drugs that fall under Schedule 1 or 2, you have to calculate your taxable income without including your selling, general, and administrative expenses. So ever since then, and with the proliferation of the medical market and the rec, from the 90s into the early 2000s, a lot of people have tried to figure out a way to say 280E doesn't apply. So some of the early court cases, they talked about different activities. Then they tried to challenge what the word trafficking is, and a few other very creative things. They also tried to challenge, intrastate versus interstate, and say that, the federal government didn't have the authority in the manner that they were policing it, correct? And so, about 3 years ago, right? Or 2 years ago now, 3 years ago, when the HHS finally came out with their big report. I think it was August of 23, if I'm correct. Soon after that, what you started to see was public companies making public statements on their investor calls about taking positions that were more academic than we'd seen in the past. And they said that they had a reasonable basis, a legal opinion, to not apply 280E, that cannabis was no longer subject to 280E. And for a while there, we as practitioners did our research to try and figure out what exactly they could be talking about, because nobody would say it out loud. It was trade secret, right? Now we have some court cases. We have some background, some things we can look at and say, okay, now we're better understanding these positions. So it's a couple different things, right? One, we're questioning whether or not cannabis is within the meaning of Schedule 1 or 2. So when the law was written, it was written very specifically. It didn't say if it's on Schedule 1, it said if it's within the meaning. And we see that in the court filings, that's something that's being challenged. The idea of intrastate versus interstate is still being challenged. There's a court case that is working its way through up in New England. And then a few other things. Is it prohibited? Also a question. If the government has carve-outs that allow for medical, and the Rohrabacher-Farr Amendment that keeps making its way into the budget bill every year, saying that the government won't prosecute medically licensed businesses. Is it really prohibited? So all of this culminates in this reasonable basis position, and I'm happy to be here to talk about it today.
Excellent, Ray. Thank you. It's interesting. Can you just dive, before we ask Wendy a question, can you just dive into the actual theory of the position relative to the FDA's approval of certain drugs?
As part of this position, this stance that it's not technically prohibited any longer, one of the things that happened, and the government actually is the one who wrote the book on this, right? In this August report, is they pointed out that the government has started approving drugs that derive their main ingredients from cannabis plants. Now, that could be in the two very well-known species of plants, the indica or sativa. It could also be on the hemp side. As you know, there's multiple types of cannabis plant that all fall within that family. And not that I'm here to pretend I'm a botanist. I failed science. I'm an accountant. But, the federal government has since approved drugs that have THC in them because it's the active ingredient, because they basically are admitting to the fact that there are medical benefits. So you have the HHS having this position and publishing it and recommending rescheduling at that report. And then years earlier, in 2018, the loophole that really opened up all of this was that the Farm Bill in 2018, led by Mitch McConnell from Kentucky, he really wanted to promote hemp in his state, saw it as a possible replacement to tobacco down the road, right? They carved out, on purpose, a new definition of what's cannabis. And they did it purposefully to exempt hemp because hemp has very trace amounts of THC in it. So they said if it's grown per a pilot program that's state compliant, and if it has less than 0.3% on a dry weight basis when it's tested, that product would not be considered cannabis. Now that definition expands, and it mentions that anything that's a derivative after the fact is also not cannabis. So what that did was it left this loophole potentially for the hemp industry to create new products that had any amount of THC in them, but they would no longer be considered hemp. And so that's actually a second position. There's a reasonable basis position that the cannabis industry as a whole is taking, and then there's kind of the hemp carve out. And these are two very important topics that require a lot of discussion.
So what I'm hearing you say, Ray, is when you look at the definition in 280E, and when you look at within the meaning of Schedule 1 or Schedule 2, and cannabis is currently classified as a Schedule 1, and if you look at the definition in the CSA of a Schedule 1 drug, it has no medical purpose. How can the IRS say that when you look at the code section within the meaning of Schedule 1, if Schedule 1 has no medical purpose, it flies in the face when you've got the FDA approving drugs that this should not be within the meaning of a Schedule 1 drug where it's classified. And so when you look at the combination of the language with what the FDA has done, it is the pinnacle of the argument of the non-280E position. And some of these legal opinions clearly expose that in the opinion. So on that topic, Wendy, what is an uncertain tax position, and what does that mean from a GAAP financial perspective?
For sure. Thanks, Steve. So an uncertain position it's a accounting position. So this is separate from your tax return. And under GAAP, it's when there's too much doubt about whether your tax treatment will be upheld if the IRS takes a closer look. So what we have under the GAAP standards is what's commonly referred to as a more likely than not standard, which it's not a bright line. It's more likely than not, but it means we can only recognize the tax benefits, meaning take those additional tax deductions on your tax return and have that be recognized if it's more likely than not to be sustained when you're in IRS tax court. And so as the accountants or as your auditors, if we can't reach that threshold, and usually we're referring to that as being more than 50% likely. So if you're not more than 50% sure that that's going to be upheld in tax court, you basically have an uncertain tax position. And so that uncertain tax position flows through to your GAAP financial statements as an uncertain tax benefit liability and a corresponding charge to your tax provision expense for the tax effect of that position. So it just comes down to likelihoods and certainty on where you think that position is going to land with a tax court.
So Wendy, if I can just recast that relative to financial statement presentation, the more likely than not standard, which is greater than 50% chance of the position being sustained, unless we meet the more likely than not from a GAAP financial perspective, the financial statements have to reflect the liability, even though we're not taking a position that says, hey, we're subject to 280, we're not subject to 280E is the position we're taking. So from a GAAP perspective, unless we satisfy a greater than 50%, we still have to accrue a liability is what I'm hearing from you.
Exactly. So you're going to do kind of a with and without principle. So we're going to say with the tax position that 280E doesn't apply to us, we get one expense under taxes. And then without the tax position existing or taking that tax position, we have a greater expense. And that difference becomes your uncertain tax position.
Wonderful. Wonderful. And Ray, from the tax return perspective, talk a little bit about what uncertain tax positions mean, because I know the definition is different from a financial statement perspective as it is a tax position. So talk to us a little bit about an uncertain tax position from a tax return perspective.
Sure. So there's a hierarchy of how you determine whether or not you can sign a tax return, right? So there's substantial authority. You're taking a position that's well known, it's unlikely to be challenged, and you win. And you can sign that return with no additional disclosure. And that's 99% of the returns we as a firm put out, right? Then if it becomes uncertain, which actually tax has a different definition of uncertain than GAAP. So when we talk about needing to disclose a position that we're not quite sure whether or not it'll be sustained, we look at a 20 to 40% threshold of success. And that's that reasonable basis threshold. We think that an argument is academic, that it has a chance to win, but it can be contested. And we have to, per IRS regulations, put a disclosure statement on the return. And then if you are less than 20% certain that you're going to win, then you start to get into frivolous position territory. And as a practitioner, you can't sign the return. And that's just patently improper, laughable. And the IRS even has like a dirty dozen type list of frivolous positions to specifically tell people, don't bother. If you come to court with this, you're going to get slapped twice as hard back, right? So these positions that are coming out and in the court cases we're seeing, what we believe is that these positions are going to all fall into the realm of reasonable basis. So if the taxpayer has an audited financial statement, then tax follows GAAP, right? If there's a UTP, an uncertain tax position on the GAAP financial, then we're going to, as practitioners, also have to put a schedule UTP on the return. And what that does is it more or less says, hey, IRS, we're taking a position. We know it might be contrary to the norm, but we believe we have a strong argument, a reasonable basis to take it. In a lot of cases, we're going to have law firms give opinions and we're going to rely on that professional. But, to be fair to everybody, we're going to disclose it to you. So we put that schedule UTP on the return, but we calculate tax without regard to 280 because we don't believe it applies to this business. Now, it's just important to note that most taxpayers don't have audited financial statements, especially in cannabis, right? They don't have bank financing. They don't have that requirement. There is another disclosure that's similar that would apply to a non-audited client, and that is an 8275. But it acts very much the same. It's a disclosure statement that says, hey, IRS, again, we're doing this. We think we're correct. But if you want to talk about it, let us know. And as practitioners, we have to put that in. Otherwise, we can't sign the return. We'll be subject to penalties. The client will still be subject. It would not be a best business practice.
So, Ray, what you're saying is, from a tax perspective, this uncertain tax position, in order to sign the return, we have to have something called reasonable basis, which is greater than 20%, less than 40% chance of sustaining the position on the tax return. And you talked a little bit about, the accounting firm being able to sign the tax return, but I also wanted to just magnify that if we sign a tax return that has less than a 20% chance on the position being sustained, it's much more than just the accounting firm having the ability to sign that tax return. It's a question of whether or not the IRS has a more likely than not chance that they will assess a penalty for a frivolous filing from the taxpayer's perspective. So there's skin in the game from both sides. It's the accounting firm, but it's also the ability for the IRS to slap some significant penalties if we file a tax return with a position that doesn't have the 20% chance of sustaining the position. And with that 20%, you're saying we have to file a disclosure statement, whether it's one of two forms with the tax return. So talk to me a little bit about, the client's retaining counsel for an opinion letter. What does that do for a client taking this position?
That's a great segue, and I appreciate the question because we're talking about penalties from a signing position standpoint, but it's important to note that with a position like this, the taxpayer could still lose. Even the best professional that we've talked to in the space is not going to say there's more than a 40% chance of success. So it's important to talk to taxpayers about the fact that this position will likely get audited because it is uncertain. And if they lose, not only would they owe the original tax, but they'd also owe penalties and interest. And then on top of that, depending on how everything goes to the IRS, and I guess the mood of the auditor or the supervisor at that point in time, they may attempt to assess an additional 20% penalty for substantial understatement of tax, right? What we refer to commonly as just the multiplier on top of taking an aggressive position. And we saw this in Harborside, actually. And it was very impressive in Harborside because the owner there managed to get up on the witness stand, provide reliable testimony, and get those penalties waived because he could prove that he relied upon a professional and the best advice at the time. And so in retaining legal counsel, that's why we talk to our clients about retaining legal counsel and getting a formal opinion, because if they want to have a chance to get out of that multiplier, they need to show that they did their due diligence. They need to show that they relied on advice of a professional. And that really is what the tax opinion becomes. It's that insurance policy, and it gives you something to give back to the auditor on an IRS audit. Say, okay, maybe we disagree, but I did everything I could within my power to perform the due diligence and to be as correct as possible.
Understood. Thank you. Let me ask you, what happens? We take the position, non-280E position, we file the disclosure statements, and we get a legal opinion, we get an IRS audit letter. Now what? What does this look like, Ray? What is the timeline? What does it look like for the accounting firm representation? What does it look like from a tax attorney perspective? And obviously it's a negotiation, but talk with us a little bit about the process.
So a timeline is not something I can say with certainty, right? An audit can happen the day after you file a tax return. It can happen generally up to 3 years after the tax return. That's the general statute of limitations, either 2 years after you pay or 3 years after you file. Now, in certain limited circumstances, you could also have a 6-year or an unlimited statute of limitations. I don't think either of those apply here, so we don't really need to go into them. But an audit can always happen. And it is highly likely if you put one of these disclosures on your return that you will get audited. And at that point, just handle it like any other audit, right? You'd work with the IRS, you'd explain the position, you'd show your documentation, your due diligence, and then, it could go one of a few ways. Now, either you might settle, you might agree to hopefully some middle ground, and you might give back and call it a day and go on with business as usual. Or you might decide to fight tooth and nail and say, I firmly believe this and I'm going to take it to the next level, which could mean you go to tax court and you attempt to defend the position along with your legal counsel. If you lose there, you can appeal it. If you lose there, it could go to the Supreme Court. It's uncertain how exactly that would play out. It's very circumstantial.
Excellent. You talked a little bit about time horizons. Talk to us a little bit about the statute of limitations. So what are we talking about? Is this it's a 3-year window? Assuming it's a 3-year window, when does that 3 years start, Ray? So that people can, count down on the clock if they haven't received an audit letter just yet.
Sure. So if you file before the first deadline, it tends to start on that deadline, right? So if you have a 4/15 deadline as a corporation, that's when your window starts. If you go beyond that, if you extend, then it's either 2 years from the date you paid or 3 years from when you filed. Now, assuming that you pay before you file or when you file, it's 3 years from when you file. If you amend, there's some caveats there. It doesn't completely restart the statute of limitations. It depends whether or not it increases your tax or decreases it, and the IRS might be given an additional 60 days to review the matter. But for the sake of conversation, let's just say it's 3 years for most taxpayers.
Excellent. Thank you. Wendy, what does this look like in our financial statement? So we talked about a 20% threshold for tax purposes, and all of the law firms out there giving these opinions, the best they can achieve is what's called a reasonable basis position, which Ray defined as between 20% and 40% chance of sustaining the position. But you earlier said to us, well, from a GAAP financial statement perspective, it's more likely than not. So it's greater than 50%. So if it's greater than 50%, this position does not satisfy a position that we would not have to address in the preparation of a financial statement. So what does that differential look like on a financial statement?
So yeah, we got a lot of percentages we're throwing out there, but in the end, we're not meeting more likely than not under GAAP. And so you have an uncertain tax position, and you're going to have it's going to be a pretty dramatic effect on your financials. So for starters, you're not paying that difference in your tax liability. So I mentioned earlier, the uncertain position is the difference between if I follow 280E and if I don't follow 280E. So we're not following 280E on the return, and so we're not paying the tax related to following 280E position. So instead of having a current liability for taxes payable, the uncertain tax position moves that down into a long-term liability. So we're not paying current taxes. We have an uncertain tax position that's a long-term liability. So pretty dramatic effect on your current position in your balance sheet, meaning you're moving a lot of liabilities from current to long-term. So your current position looks stronger. But when we look at the income statement, you still have that expense as if you're following 280E. And so your income statement won't change all that much. You'll have some additional penalties and interest, but by and large, your income tax expense, your provision for income tax expense is going to be very similar whether you're taking the non-280E position or following 280E. So for income statement, your net income is going to look pretty similar. Your balance sheet from a current position may look stronger because you're having more liabilities sit in long term. So you're able to cover your current expenses more aptly. As far as other measures, so your EBITDA, that already excludes taxes, so that won't change quite as much. But basically, you're looking like you're going to have a stronger balance sheet position because you don't have this giant current tax payable. So that's the big impact.
Understood. So even though we're taking a non-280E position, we still have to accrue this, but it's a long-term liability because we don't know if it's going to be paid or not paid. So yeah. What does the footnote look like, Wendy? Like, what is this? What's the opinion? Like, are we modifying the opinion? Are we modifying the financial statement footnotes? What does that look like?
Yeah, definitely. So your tax footnote in your audited or reviewed financial statements under GAAP, you're going to have a big impact to that tax footnote. It's all about transparency under GAAP and the standards that talk about tax footnotes. So an uncertain tax position in general is not a new thing in GAAP. Uncertain tax positions go way back. So there's already disclosure standards when it comes to taking an uncertain tax position. You're going to talk about your reasoning taking the tax position, which will pretty much be coming from ideally your legal opinion about why you think 280E doesn't apply to your business. You're going to lay out when you think the uncertain tax position may be reversed and what things would cause it to be reversed. So that's where your statute of limitations disclosure may be pulled in there. You're also going to have some disclosures on year over year, kind of a roll forward position of what that uncertain tax liability looks like. So was there new positions taken on current periods, or was there new positions taken on prior periods? what was released from the uncertain tax position. So it becomes very transparent on the changes to that uncertain tax position liability in your footnote. And all of that falls under your GAAP required disclosures. So pretty much that's non-negotiable as to what you're including in those financial statements. What becomes a little bit negotiable or a little bit of a gray area you mentioned is there going to be an emphasis of matter in my audit opinion or in my review opinion as it relates to this uncertain position? So it depends very much on the materiality of the position, but some auditors will say, yeah, we want to draw attention to the reader to this footnote because it's a significant position. It's uncertain. There's some estimates in there for sure. And so it's not necessarily saying, hey, these statements are wrong. It's just directing the reader's attention to, hey, go look at the tax footnote because there's something important in there that could have a material effect on the future liabilities of the company if this does become a payable. So this disclosure is becoming very standard in the industry. We have a lot of people taking a non-280E position. Like I mentioned, uncertain tax positions aren't new in the auditing world or the accounting world. People have taken uncertain tax positions since the beginning of time. And so in the cannabis world, it's becoming very common to see these additional disclosures. So it's great that they're there. Transparency is key. Disclosing your risk. It's becoming very common to see these additional disclosures.
Thank you, Wendy. It's interesting. We talked a little bit about what happens in an audit and the timeline, and we've been having significant conversations with our clients. Very large clients, mid-sized clients, multi-state operators, and startups. And my biggest fear is we take the position, we get an opinion letter, we get an audit letter, and it results in a journey to court that Ray had outlined earlier. And that journey is wrought with cost. And I think to take the position and feel good about it, I think you've got to be able to come to grips with the fact that when and if you get that letter, there will be accounting fees, there will be legal fees, all the way through resolution. And I think for sometimes it's better off to let the larger players fight this out in the industry. And if they're successful, you can certainly go back and amend the returns that are still considered to be open years and claim refunds if the taxpayers have a victory in this issue. So for some of the smaller players, you really got to think twice, because if you don't have the war chest to be able to sustain the legal fees on the journey, this is not going to be a pleasant experience. I like, that's a straight up conversation. The benefits are clear. Wendy, what happens if in the financial statements, let's assume the earlier of a successful resolution to this issue by someone in court that we can use as authority, or what happens when the statute of limitations expire and you didn't get audited and now you've got this liability on your balance sheet? What happens, Wendy?
That would be a very exciting time for us. So at that point, we have a change in circumstances. And so you can then determine we are more likely than not that this position is going to be sustained, whether that is because you mentioned we have some substantial victory in a case and we have some probability based on law and precedent that gets us over the 50%. So that's a change in circumstance. Or you are confident that your statute of limitations has expired. And Ray mentioned usually that's the 3 years. Sometimes it can be 6, sometimes it can be longer. So you have to be pretty confident and be able to document that your statute's truly expired. But in that case, we're now over the hump. It is more likely than not. And so now our position is not uncertain. It's likely to be sustained. And so you don't have this liability anymore. So what we do is we reverse the liability, we take it into income, through your tax provision expense. So we'll have a tax benefit in your income statement. And you do that in the current period. So you don't go back. There's no restatement. There's no look back. It's in the year or in the period in which we have that we overcome more likely than not. We're going to take that liability, remove it, and we'll take it into the income statement. So you'll have a bit of a bump in that year and definitely something worth celebrating as we move forward.
Excellent. Thank you. Well, thank you, Wendy. I just want to say this is our first podcast in the series, in our What the Hemp series. And I just want to thank everyone. I hope you found this program informative. And thank you, Wendy Heiss and Ray Owens, for joining us. Be sure to tune in to our next episode and visit us at witham.com/cannabis for more information and industry insights. And until next time, thank you very much. Have a good day.
Thanks for joining us. Be sure to subscribe to our podcast so you'll be first in line to hear what's coming next. Don't want to wait for our next episode? Check us out at witham.com. That's WITHUM.com.